There is a silent mechanism operating behind the global economy, and it moves trillions of dollars every year. This mechanism isn't found in central banks or parliaments. It operates in small jurisdictions, often overlooked on the map, yet wielding disproportionate power over international capital flows. These are the so-called tax havens. Over the past few decades, these territories have specialized in offering tax advantages, legal secrecy, and tailor-made corporate structures, attracting individuals and companies in search of tax efficiency, asset protection, and financial anonymity. The Cayman Islands, Luxembourg, Ireland, and Singapore have become strategic hubs for massive conglomerates, billion-dollar funds, and complex investment networks. But none of this is necessarily illegal, and in many cases, not even immoral. It reflects a global economic logic that is permitted, encouraged, or simply tolerated by governments around the world. The reality is complex. Some see this system as a threat to tax justice and national sovereignty, while others view it as a legitimate financial planning tool in the face of inefficient domestic regulations. As the debate continues, the system keeps expanding and remains invisible to most people. This documentary will explore that universe through data, context, and depth. No easy answers, no cartoon villains, just the reality of how trillions of dollars circulate quietly, yet at the very heart of global economic power. Imagine a world where trillions of dollars circulate every year, without headlines, without alarm, far from the eyes of most people. This is the world of tax havens, small jurisdictions that operate as financial vaults for tycoons, corporations, and even governments. According to the Tax Justice Network, approximately $10 trillion in assets are hidden in these territories, more than the GDP of many entire nations. Names like the Cayman Islands, Luxembourg, and Singapore have become synonymous with banking secrecy, aggressive tax planning, and inequality. But this doesn't just affect massive fortunes. When wealthy individuals and corporations pay less tax than they should, governments lose revenue, and we all feel the consequences. The Tax Justice Network estimates that over the span of a decade, more than $4.7 trillion in tax revenue is lost due to these practices. That money could fund healthcare, education, and infrastructure. Beyond financial conglomerates, sectors such as online gambling, casinos, and even illicit activities like drug and arms trafficking also rely on offshore structures to hide assets and launder money. The International Consortium of Investigative Journalists has exposed how global power networks use these mechanisms to evade public and legal scrutiny. While there have been isolated advances in international cooperation, most tax havens still resist meaningful transparency. According to the Financial Times, many of these jurisdictions continue operating without public records revealing the real owners of companies. The result is a dual system, a visible world where everyday citizens pay taxes on every dollar, and a parallel world shielded by foundations, trusts, and international law firms. In this context, tax justice remains a distant promise. After scandals like the Panama Papers, 2016, and Pandora Papers, 2021, many believe the days of tax havens were numbered. The reality turned out quite different. The system didn't disappear. It evolved. Instead of traditional banking secrecy, complex legal structures emerged to conceal the true owners of wealth. Trusts, holdings, and offshore foundations, especially common in places like Panama and Liechtenstein, make investigations difficult and shield assets from scrutiny. A study by Transparency International revealed that 70% of luxury properties purchased by foreign buyers in London between 2016 and 2021 were acquired through companies registered in tax havens. The digital era has expanded these possibilities even further. Platforms like Binance and Bitfinex, registered in jurisdictions such as the British Virgin Islands and Seychelles, offer users extreme levels of anonymity. In 2022, according to Chainalysis, $23.8 billion was laundered through cryptocurrencies, much of it flowing through digital tax havens. Countries like Estonia and Malta have adopted flexible legislation to attract such businesses, positioning themselves as modern hubs for digital tax evasion. There is also a geopolitical contradiction. Countries that lead the charge for transparency, like the United States, maintain their own domestic tax secrecy zones. The US, for instance, has refused to sign the International Common Reporting Standard, CRS, for automatic exchange of financial information. allowing states like Delaware and South Dakota to operate as internal tax havens. International initiatives such as blacklists and EU resolutions often come across as diplomatic theater rather than effective policy. Smaller nations like Samoa or Fiji are frequently included, while major financial hubs like Luxembourg or the Netherlands, both well-known facilitators of aggressive tax planning, are left out. The system adapts, exploits legal loopholes, and outsources its opacity. Beneath a surface of compliance, trillions of dollars continue to circulate in the shadows. At first glance, global trade seems to operate under clear rules, tariffs, competition, and multilateral agreements. But behind this facade, tax havens function as hidden gears that distort the international economy. Multinational corporations like Apple and Nike have faced strong criticism for using transfer pricing mechanisms to shift profits to low or zero tax jurisdictions, such as Ireland and Luxembourg. In 2016, the European Commission ruled that Apple should pay 13 billion euros in back taxes to Ireland, accusing the company of benefiting from illegal tax agreements. These practices divert revenue away from countries where real economic activity takes place and weaken public finances. By prioritizing tax advantages, corporations shape their supply chains artificially, opening fictitious subsidiaries purely for accounting purposes. According to UNCTAD, more than 40% of global foreign direct investment flows through offshore financial centers, illustrating a system where capital follows tax incentives rather than social or productive logic. The consequences are profound. Economist Gabriel Zucman estimates that the wealthiest 0.01% hide up to 25% of their fortune in tax havens, while the poorest segments of society face budget cuts, inflation, and underfunded public services. Tax evasion institutionalizes inequality, creating a cycle in which those who influence policy the most contribute the least, and the rest of society bears the burden. In Africa, this imbalance is even more stark. The United Nations estimates that the continent loses $89 billion annually to tax evasion and capital flight, funds that could be invested in education, healthcare, and infrastructure. Countries like Nigeria and Angola see their natural wealth extracted and their revenues vanish through offshore structures in jurisdictions like Mauritius, Jersey, and Switzerland. This model reshapes the rules of global commerce. Corporations no longer choose their locations based solely on productivity, but also on tax advantages. This forces countries into a race to the bottom in corporate taxation. According to the IMF, this global tax competition costs between 0.5% and 1% of global GDP every year. Illegality is not always present, but structural injustice is, and it's redefining the global economy in favor of those who contribute the least to the common good. In recent decades, the fight against tax evasion has gained momentum with the creation of mechanisms such as the Common Reporting Standard, CRS, developed by the OECD. This system enables over 100 countries to automatically exchange financial information, making it harder to conceal assets. However, significant loopholes remain. The United States, for example, has not fully adopted the CRS and instead implemented its own system, FATCA. As a result, states like Delaware, Nevada, and South Dakota have become safe havens for foreign capital, with laws that guarantee anonymity for beneficial owners. In 2021, more than 130 countries reached an agreement under the OECD/G20 framework to implement a global minimum corporate tax of 15%. The goal is to curb the race to the bottom in international taxation. Despite being a major step forward, implementation has been slow and uneven, and developing countries argue that the model disproportionately benefits wealthier economies. Leaks such as the Panama Papers, Paradise Papers, and Pandora Papers expose the systematic use of offshore companies by political leaders, business people, and celebrities. Although many of these schemes were technically legal, they revealed the extent and normalization of offshore financial structures. In most cases, the consequences were political and symbolic, with little to no legal accountability. Institutional responses remain inconsistent. The European Union maintains a blacklist of tax havens that often omits major financial centers like Luxembourg or the Netherlands while targeting smaller and geopolitically weaker nations. According to the Brookings Institution, global regulation will remain fragmented until a new international agreement is reached on taxation, transparency, and capital mobility. Until then, cosmetic reforms will prevail, and vast flows of wealth will continue slipping through the cracks of the system. International pressure for transparency hasn't eliminated tax havens. It has transformed them. Jurisdictions like Luxembourg, the Cayman Islands, and Singapore have adopted superficial regulatory frameworks while maintaining legal structures that enable secrecy and aggressive tax planning. The system hasn't disappeared. It has evolved, become more sophisticated, and gone digital. Even though mechanisms like automatic information exchange have expanded oversight, loopholes still allow assets to be hidden through complex legal arrangements. Scandals like the Pandora Papers have shown how heads of state, business leaders, and celebrities continue to use offshore companies to protect and move their fortunes. These leaks revealed that even when no laws are broken, the system functions as a shield for a globally connected elite. The rise of digital assets has introduced new challenges. Tools like Tornado Cash and advanced anonymity crypto wallets make transaction tracking extremely difficult. In 2022 alone, over $23 billion was laundered through cryptocurrencies, much of it operating in loosely regulated zones. Despite sanctions and law enforcement efforts, technological infrastructure is outpacing legislation. Meanwhile, countries like the United States continue to offer domestic tax secrecy zones. States such as South Dakota have become global hubs for trusts, attracting hundreds of billions of dollars. The paradox remains. Nations that advocate for transparency publicly maintain practices that perpetuate opacity.